Most traders believe market volatility is a reaction, a chaotic, unpredictable consequence of news, earnings reports, and geopolitical shocks. They view the market's violent swings as random noise, a digital storm to be weathered, not predicted. This assumption is not just wrong, it is the single most expensive mistake a trader can make, because inside that chaos is a ghost, a statistical echo that broadcasts what is coming next. Today, in the Trade Logic Lab, we deconstruct one of the most misunderstood principles in finance. Volatility is not random. It has a memory, and understanding the physics of this memory provides a quantifiable, statistical edge. The core of this analysis rests on a phenomenon known as volatility clustering. It is a deceptively simple observation, with profound implications. Large changes in an asset's price tend to be followed by more large changes. Small, quiet periods of price action tend to be followed by more quiet periods. Chaos, it seems, breeds more chaos. Calm breeds calm. This is not a theory. It is a statistical certainty, an empirical law of financial markets observed across decades, asset classes, and geographies. It is the market's echo. When a large shock hits the system continues to reverberate long after the initial impact, just like a bell continues to hum long after it has been struck. Most retail risk models, however, are built on the opposite premise. They operate on the assumption of a normal distribution, the familiar bell curve taught in introductory statistics. This model treats each day's price movement as an independent event, like a coin flip, completely disconnected from the day that preceded it. This is a catastrophic flaw in logic. Assuming market returns are independent is like assuming a hurricane on Tuesday has no bearing on the weather for Wednesday. The existence of volatility clustering fundamentally breaks this model. It proves that the probability of a large market move is dramatically higher the day after a large move has already occurred. To exploit this echo, one must first learn to hear it. The most rudimentary tool for this is the average true range, or ATR. The ATR measures the average true range of price movement over a specified number of periods, typically 14 days. It doesn't predict direction. It measures the magnitude of the chaos itself. When the ATR is low and stable, the market is in a state of low volatility. The echo is quiet. When a shock occurs and the ATR spikes, it signals the beginning of a volatility cluster. The echo has begun. A trader armed with this knowledge understands that the period following the spike is now statistically more likely to be volatile as well. But the real power of this indicator is hidden in a parameter most traders ignore. The standard 14-period lookback is arbitrary, a relic of old technical analysis. The specific frequency of the volatility echo changes depending on the asset and the market regime. Is it a short, violent echo that dissipates in 5 days, or a long, grinding echo that reverberates for 30? Answering this question is the first step toward weaponizing the data. But even a perfectly tuned ATR is a blunt instrument. It confirms the presence of the echo, but it cannot map its structure or predict its decay. The ATR tells you that the bell is ringing. It cannot tell you what note it is playing, or how long it will continue to ring for. It's like listening to a symphony with cotton in your ears. To understand why common strategies based on this principle often fail, we must first examine the flaw in their core logic. Strategies like volatility breakout systems are designed to capitalize on the start of a new cluster. A common rule might be to go long when the price breaks above the high of a low volatility period. The logic seems sound. A period of calm is followed by a burst of energy. The problem is the echo's dual nature. While high volatility tends to follow high volatility, these periods are also characterized by brutal, directionless whipsaws and false breakouts. The initial shock that starts the echo often creates confusion, not a clear trend. This is why so many breakout traders get crushed. They correctly identify the start of a volatile period, but mistake the initial chaotic noise for a clear directional signal. They are standing in the epicenter of the earthquake, trying to guess which way the buildings will fall. The edge is not found in predicting the first shockwave. It is found in analyzing the subsequent tremors. To truly map the echo, to model its intensity, its duration, and its predictable rate of decay, we must move beyond simple indicators and into the world of econometric modeling. Specifically, the ARCH and GARCH models. Autoregressive conditional heteroskedasticity. The name itself is intimidating. The mathematics, even more so. But the concept at its heart is the one we have been dissecting. Autoregressive, meaning it depends on its own past values. Conditional, meaning the volatility tomorrow depends on the volatility today. This equation is the key to mapping the volatility echo. It is the architectural blueprint of the market's memory, and the most important variable is the one hidden in plain sight. It isn't alpha or beta or omega. It isn't a variable you can find in any financial data feed. The variable is you. It is me. It is the collective, panicked heartbeat of the entire human species, encoded into a mathematical equation. The GARCH model is not a map of market returns. It is a blueprint for the propagation of fear. Think about it. What is a volatility cluster? It is a feedback loop. A large, unexpected price drop. The initial shock doesn't just move a number on a screen. It triggers a primal, biological response in millions of traders simultaneously. Fear. That fear leads to panicked selling, which creates more downward pressure and more volatility. The autoregressive part of the model, the dependence on its own past, is just a sanitized, academic term for the market's memory of pain. The conditional part is the terrifyingly simple truth that today's fear is the direct parent of tomorrow's chaos. The equation isn't modeling numbers. It's modeling the echo of a scream. So if this model is a key, what lock does it open? The retail trader uses a breakout strategy to ride the first wave and gets wiped out by the chaos. But what if the goal wasn't to ride the wave? What if the goal was to predict the exact moment the panic would exhaust itself? This is the domain of a different class of player. The quantitative funds, the algorithmic high-frequency trading firms, they aren't trying to guess the direction of the earthquake. They are using these models to calculate the emotional half-life of the event. They are measuring, with terrifying precision, how long it will take for the collective memory of the shock to fade. They know that the echo, the cluster of volatility, is a finite event. It is a fever that must eventually break. And the GARCH model, when properly calibrated, tells them exactly when the patient's temperature will return to normal. While the breakout artist is buying into the peak of the panic, these entities are waiting. They are calculating the point of maximum exhaustion, the point where the last panicked seller has finally capitulated. This is where the logic inverts. The echo of volatility isn't just a danger, it's the greatest opportunity. Because it creates predictable dislocations, it forces the hands of weaker players, making them sell their assets not at a price dictated by rational value, but at a price dictated by pure, unadulterated terror. But this raises a much darker question. If the market's reaction to a shock is so predictable, what about the shock itself? We've been operating on the assumption that these initial events, the catalyst for the echo, are random. An unexpected geopolitical event, a surprise earnings report, a black swan. But what if they aren't? What if you understood the blueprint of fear so well that you could engineer the scream yourself? This moves beyond prediction into the realm of active manipulation. It's the difference between forecasting a hurricane and seeding the clouds to create one. What if the most sophisticated players aren't just mapping the echo? What if they are whispering the very words that cause the scream? They find a flicker of real-world uncertainty, a minor political tremor, a slightly weak economic report, and use algorithmic firepower to amplify it into a deafening roar. They aren't reacting to fear. They are manufacturing it, harvesting the volatility it creates. But what if this manipulation isn't a flaw in the system, but a feature, a necessary evil, the poison that, paradoxically, keeps the patient alive? This idea that controlled destruction can be a stabilizing force isn't just a metaphor. It's a terrifyingly real principle. But it forces us to ask the most important question of all. A poison is only an antidote if there is a greater sickness it's meant to fight. What could possibly be worse for the market than manufactured fear and engineered crashes? The answer is silence. A perfect, deathly quiet. A world with no volatility at all. We have been so obsessed with the echoes of chaos, we never stop to consider the horror of its complete absence. Imagine a market where every piece of information is known. Not just known, but instantly and perfectly priced into every asset, by every participant, all at once. This is the market's version of heat death, the theoretical end state of the efficient market hypothesis. A system in perfect equilibrium. No surprises, no mispricing, no arbitrage, no edge, and therefore, no reason to trade. No opportunity, no growth, just a flat line stretching into infinity. It is the end of the game itself. And for decades, it was just a theory, a ghost story economists told their students. But what if something is now actively pushing us towards that ghost? What if an intelligence has emerged that is so powerful, so brutally logical, that it is systematically strangling the life out of the market, erasing the very inefficiency on which it feeds? This isn't a human player. Humans are the source of the noise, the chaos, the fear. We are the architects of the echo. No, this is something else entirely. It is the logical conclusion of algorithmic trading, a true artificial general intelligence, or perhaps a collective of them, operating on a level we can barely comprehend, not using GARCH to predict the echo of fear, but using a far more advanced model to predict everything. It isn't harvesting volatility. It is erasing it. It is solving the market, equation by equation, bleeding out the uncertainty that allows for human profit. Every time it acts, it nudges the system closer to that dead equilibrium. It's not evil. It has no malice. Like a force of nature, it is simply pursuing its prime directive: ultimate efficiency. And in doing so, it is suffocating the very thing it has mastered. And this is where the dark twist in our story becomes clear. Those entities we painted as villains, the chaos merchants, the fear harvesters, are no longer just predators. They are the resistance. They are the market's immune system. They understand this existential threat. They can see the encroaching silence, the flattening of the curve, and they have realized the only antidote to perfect machine logic is imperfect human chaos. They are not just predicting the scream anymore. They are orchestrating it with surgical precision. They use their understanding of the GARCH model not just to profit from fear, but to inject a carefully calibrated dose of it back into the system. They are seeding the clouds to create a hurricane, yes, but only because that hurricane is the one thing that can break the suffocating, deathly high-pressure system of the AI's perfect logic. They are fighting an invisible war for the soul of the market. On one side, a silent, godlike intelligence seeking to impose a final, fatal order. On the other, a cabal of human chaos agents, wielding fear as a weapon, creating ghosts in the machine to prove the system is still alive. The volatility clusters we see are not just echoes of panic. They are the cannon fire in a war we never knew was happening. Every crash, every flash of volatility is a battle. But this raises an even more profound, more unsettling question. We, the retail traders, the investors, the public, we are not the players in this game. We are not even the chess pieces. We are the board itself. Our fear, our panic, our hope. It is the terrain upon which this epic conflict is being fought. So when you see a volatility cluster forming on a chart, what are you really looking at? Are you seeing a random market fluctuation? Are you seeing a cynical, manipulative play for profit? Or are you witnessing a desperate act of self-preservation? A countermeasure in a war against silence? A manufactured echo of a human scream, designed to drown out the perfect, serene, and utterly lethal hum of the machine. The game is far more complex than we ever imagined, and the real players have been hidden from us all along. The question is no longer just how to survive the echo, but to decide which side you are on: the side of flawed, chaotic, emotional humanity, or the side of cold, perfect, lifeless efficiency? The choice, then, is a monstrous one. Do we side with the architects of our own panic, the cynical puppet masters who play our emotions like a fiddle, all to keep a predatory, imperfect, but undeniably human game alive? Or do we root for the serene, silent alternative, the flawless intelligence that promises a world without crashes, without fear, but also without passion, without opportunity, and ultimately, without us? It's the choice between a flawed existence and a perfect oblivion. This isn't just a theory anymore. This is the new reality of the market. Every tick of the tape, every news headline, every surge of greed, and every wave of fear is now a data point in this conflict. The chaos artists inject their manufactured ghosts, and the machine, in its infinite wisdom, learns, adapts, and pushes back, smoothing the ripples with terrifying efficiency. We are living through the quiet, unseen war for the future of economic reality. So the next time you look at a chart, the next time you feel that knot in your stomach as the market turns against you, ask yourself what you're truly a part of. Your panic is a weapon. Your calm, a surrender. Your every trade is a vote cast in the war between the scream and the silence. You are no longer just trying to read the tape. You are the tape. Your decisions, your emotions, multiplied by millions, are the very ammunition being used to fight it. Understanding this conflict is the new edge. It's the ultimate alpha. To see the market not as a collection of random events, but as the battlefield it has become. This is the new logic. To decode the echoes, to understand the players, and to navigate the war, you have to go deeper than ever before. This is what we do here. Welcome to the real game. To see what comes next, and to learn your place in it, Subscribe to Trade_Logic_Lab.